black swans. What are black swans? They're unexpected events, but some black swans are right in front of our face and we can't even see them, right? And so if I may talk to our Federal Reserve, like I talk to the other companies on the other channel, Federal Reserve, stop printing money. Stop mortgaging my children's future. You already done it to the tune of $34 billion. Not billion. What am I saying? Trillion. How many zeros are in a trillion? I'm not even sure how many zeros. 12 or 6, 15? I don't even know. The point I'm trying to make to the Federal Reserve is neither printing or inflating is going to save this. It's just not going to work. In 2008, when we had the great financial crisis, it only took $800 billion, which is called TARP, right? They created the TARP fund and lowered the rates to zero, which is ZIRP, zero interest rate policy, for what, 12 years, 14, 15, 16 years, saved all the banks, which they shouldn't have been saved. Bye-bye. Some of them went under, like Countrywide did, Washington Mutual did, a lot of smaller banks went under, and then all they did is they took the banks, all these bankrupt banks, like Wachovia, and they dumped it into JP Morgan, they dumped it into Bank of America, like Countrywide and B of A. What I'm trying to say to the Fed is, this is not the way to run an economy, Fed, because you are not working for the average American. What you're doing is you're hurting the average American, okay? But I will do a separate video about that. I'm hot about this subject. However, the black swan that I'm looking at, that I've been looking at for, I don't know, a year now. What is it? Do you guys see this chart right here? This is the 10-year Treasury rate, Treasury note. This was a zero, literally zero, as you guys can see on the chart, for, I don't know, 10 years, 12 years, right? At the same time, we were printing money constantly. The printing machines were going on 24/7. By the way, the Federal Reserve Chairman on 60 Minutes said, they asked him this question, do you literally print money? They go, no, we don't print money anymore. What we do is we have our ledgers. All we do is add zeros when we want to create money out of thin air. What the F? I can't do that. I can't go add zeros to my bank account and make myself look a trillionaire. You know what I'm saying? This has a lot of problems, I mean, I'm so passionate about this subject. This is the reason, by the way, 3% of the country owns 97% of the assets. They're the only ones that can borrow at 0% and buy all the assets, okay? But I will talk about those later. So here's the interest rates, what has happened to the 10-year note, right? This, by the way, regulates your credit card debt, your mortgage, your any borrowing or car loans, any borrowing that you're going to do. Obviously, because the Fed figured, okay, we're pumping all this money, we're creating this inflation, it's hurting the people. Well, of course it is. Everything we buy is up like twice or threefold, right? So most of you don't remember this. I'm old enough to remember. In 1978, there was a Federal Reserve Chairman called Paul Volcker, right? You guys are all used to the zero interest rates for years and years and years, and that's why a lot of these traders are getting nailed, because they haven't seen it. They haven't seen higher interest rates. And you may all think from 0 to 5% almost now, interest rates are too high. Oh, no. Average mortgage in the history of this country is about 11%. We're at 7%, and the housing is about to crash, right? So, and all the housing sales have stopped because it's unaffordable to buy housing, to buy a house. Imagine you just graduate from college. What money do you have to buy a house? And then because the mortgage rates went from 3.5% to 4% on a 30-year fixed, now they're at 7.5%. Your mortgage just doubled just on the interest alone, right? But that's because of the Federal Reserve. So Federal Reserve, in their wisdom, figured, hey, man, we're inflating. Everything's price is going up. What is the way to stop that? That's the way to stop that is a brake check. Brake check in the finance world is raising interest rates, which Paul Volcker did in 1978. You know what the interest rates were in 1978, people? 20%. Do you know what will happen to this economy if Fed has to raise the rates, keep raising the rates? Number one, they're killing themselves because they have 34 trillion in debt. The servicing of that debt is automatically just, went up fourfold, the interest payments on that alone. This is what we're doing to this country. We're absolutely just ruining this country and the future generation. But again, different topic. So when the rates go up, equities don't do well. Okay. And we know, I'm going to share my screen in a minute with you guys, what happened last year. But what happens is that market is always 6 months ahead in anticipation of what the Fed is going to do, right? And this gentleman, his name is Logan Kane. He wrote it on Seeking Alpha. I like reading that thing once in a while. So this paragraph hit me really, really hot, right? So neither borrowing money nor printing is the magic trick. No shit. Our society's resources are what they are, and politics can only redistribute them in the short run, not fundamentally solve the problem of scarcity. Absolutely. The reason why millions of Americans are struggling with the cost of living is because the government printed too much money during COVID. People, in 2008, during the great financial crisis, when, by the way, the government was saying to everybody should buy a home. I had a mortgage company in between 2002 and 2008. I used to do loans to gardeners who cut my grass, calling them landscape designers, inflating their income, no income, no asset loans. And that's why housing did what it did. Everybody bought a house. And what happened? Everybody lost their house due to foreclosures because they couldn't afford those payments. Now, we're doing the same thing. During COVID, TARP was only $800 billion. Not COVID, during the GFC, Great Financial Crisis in 2008. Fast forward 12 years, COVID hits, right? Everything is crashing. Everybody is stuck in their homes because our economy depends on spending, right? It doesn't depend on manufacturing that it used to do 50 years ago. We have nothing. All we do is watch Facebook, and that's all we do is spend money. The gross domestic product of this country, 75% of it is from spending, because they want us to spend. You give the credit card, spend. Well, that's why we are where we are. But in 2020, when COVID hit, guess how much money it took to save the economy from the abyss, from depression? $5 trillion with a T. That goes right into the debt load, right? Okay. Every 10, 12 years, we'll have one of these things, right? It's a fact. You guys can go back, look at the history. Next one, because they didn't cut the rope, right? They didn't let there was something called too big to fail. They didn't allow the shit companies to fail, shit banks to fail in 2008. Now we have a bigger bubble. Now we keep building this bubble. The next event, the Black Swan event, is going to cost us, the taxpayers, at least 10 to 15 trillion dollars, because that's what happens. All you're doing is keep inflating this bubble. More debt. More companies have more debt today. Credit card debt through the roof on the personal level. Bank, company debt through the roof. Car loans through the roof. They're all going bad. Repo Man is very happy. But going back to this, stop printing money, because the dummy version of inflation means too much money chasing too few assets. And that's exactly why the stock market is being inflated. That's exactly why your house price went up 50%. It wasn't fundamental. It was too much money chasing too few goods. And now the reason that millions of Americans can't buy homes is because the feds are crowding them out by investing billions in pork barrel projects in swing states. Correct. What happens next? The government won't slow the spending because we're in an election year. We just keep adding to the bullshit. Due to high government spending and a series of hot inflation reports, the Treasury yields are near 20-year highs. Exactly. That's the first chart right here that I looked at or showed you guys. And the potential for much higher yields is supported by theoretical, practical, and historical reasons. Absolutely. We could easily reach, because the reason is they put the inflation genie out of the bottle. It is not easy to put that genie back in the bottle. You guys, they can all, every month, they can come and say, oh, no. They're even thinking about lowering interest rates, right? Do you know why? Because there is always a 6-month to an 8-month lag between economic activity and what happens to interest rates, okay? Economic activity always slows down when rates go up, right? I mean, look, I can go today, invest in a 3-month treasury bill at 5% plus and give my money to the US government with no risk. Why should I go open a business? Why should I go invest in anything? Risk-free money versus I got to do something else. Or how about the people who are, on W-2s and they don't have enough money now, right? I mean, look, inflation is killing these people. Inflation is a tax on these people. So the first punch to the American consumer, American public by the Fed was inflate, 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 inflate. Okay, we inflated. We gave everybody money that was sitting home so it can open, trade stocks, meme stocks, and blow that money as well, because that's in the, rich hands now. Then now we have inflation. Everything's prices up. So to kill inflation, the antidote to inflation is higher interest rates. That's what the Fed has done in the history of this country, and that's what they're doing now. Rates going from 0 to 5% is not a good thing, right? A lot of corporate debt is coming to get refinanced, and they're not going to be able to afford it because the economy is going to slow down. And that lag now is coming up. And you guys are going to say, well, Serge, why is the stock market at all-time highs? It's because the market is anticipating lowering rates because the Fed knows they're going to put us in a recession with these high interest rates. And the day the market tops, by the way, it will be the day they start lowering rates, because Fed never lowers rates when things are good. Fed always increases rates when things are good, and they lower rates. So basically, look at this as the gas pedal in your car. If you want to go faster, right, move the economy faster, you lower interest rates. So borrowing activity picks up and people start spending money. If you want to slow the economy, the brake is higher interest rates of the economy, right? So I have a lot more to talk about this. As you guys can say, I get hot talking about the Fed.